right, everybody. So let's go over this. So in the prior reading, I talked about the lines, drawing the lines as being the first step. Why do you draw the lines? Because the drawing the lines shows you where the test of the breakout and breakdown is going to be, where to anticipate it. It shows you where the spring is, where the upthrust is, where the absorption is, and obviously where the breakouts are, the key behaviors. But there's one really important point to note. Why do we draw the lines? Is because that is where the pullbacks have a tendency to terminate. All right, meaning if you have a break and you have a pullback, that pullback has a tendency to terminate, and that allows you to initiate a new trade. All right, here is what Weiss said about it. He says, by drawing these lines, the trader can anticipate price swings to peak or bottom around previous support resistance lines. There you go. This is the most important line in this, whatever this study about AEM is. This is the most important line because you need to know where the swing is going to terminate so you can get on the next swing. And that's why we use these lines. So the lines, they frame the setup as a break and test, or sometimes a deeper break and test, or sometimes a spring. You have a break, you have a test, you have a retest, which is a spring. All right. But the key thing is, I'll give an example. So we'll take a look here. You have this break on C. Maybe I'll use this one. All right, here, look at this. You have this break at C. You have a resistance level up here. Where does price end? It ends at B, at the resistance level. This move, this price swing, this bear pullback ends at around B, allowing you to initiate a trade that allow you to ride B all the way down to D or more. So that's the idea. All right, the lines have forecasting ability, telling you where potentially the trade opportunity is and where the pullback is going to end. It also tells you, in this case, A is up here, so you look for the upthrust at that area, and if it's there and on a low time frame, you get indications, selling indications, you take them, and you ride it. So this is the most important line here, and this is why it's so important. There's a lot of other techniques. I know volume profile, POC, naked POC, goes on and on and on. But when you're looking at price, this is what you got to do. And it's fundamental. It's basic. Everything else is an add-on. Everything else is an add-on. This is the basic 101 that you need to know and do. So the first step is draw the lines. Why do we draw the lines? Because they allow us to identify where to trade. And specifically, the setups are the break of the break in test, test of the breakout or breakdown, the retest of the breakout or breakdown, especially if it's a spring or an upthrust. And that's about it. You have springs, upthrust, and tests of breakouts and breakdowns. He mentioned some other turning point trade opportunities like absorption. But as you see, predominantly this is it. So you have, for example, here, A, you have a upthrust. Here at B, you have a break and test setup. Same thing that's over here from B. When B goes down to D, it comes back and tests this area and upthrusts it. And the list goes on and on. All right, so that's why. All right, so they become an important part of a trader's arsenal. Support and resistance lines become an important part of a trader's arsenal, especially when combined with trend lines, channels, and price volume behavior. So you draw the support and resistance line, you draw the channel, in the trend line channel, and you look at the price and volume behavior as price retests the support and resistance lines. That's what he's trying to say over here. Very important, this section here. The rest is just, talking about the rally ends, the upward spike, etc., etc. But this is what you need to focus on, and this is what you need to do. Draw the lines, frame the trade location, identify the trade location. All right? All right, this is also important. When we draw the horizontal line, we repeatedly see the false moves on either side of a trading range. Compare the false breakout on October 15th, okay, with the January spike in March bonds. All of this behavior stands out with the 8 of the lines. These are just up thrusts and springs. Like right here, B, the line at B gets tested, fake out. Here, trading ranges are horizontal patterns. They are resolved in 3 ways. All right, so how does the range resolve? All right, you got lateral movement and everyone's tired out by the formation of an apex or a false breakout breakdown. All right, so again, how a trading range is resolved. You see, when you drawing support and resistance line, you're basically, what are you doing? Right? You're drawing support resistance lines. How are those, how you're identifying the range? How is it resolved? The range is resolved in 3 ways. Basically, a lot of bars that tire everybody out. But as far as behavior is concerned, apexes, all right, apex, everyone knows what an apex is. It's basically a triangle. You see the wedges, right, or the apex or the pennants, whatever you want to call them, right? So you have that apex or a spring and up thrust. So that's how they do it. So I mean, one of the things you could do is you could draw, within that area, the apex, and you'll see that it's getting resolved. And the other thing you do is just look for springs and up thrusts. But those are the 2 behaviors that you'll find. All right. Now trend lines depict the angle of advance and decline. Their dynamic support resistance. So here Weiss says, what are trend lines? They're dynamic support or resistance. All right. That's the definition he's using. I don't want to get into like how to draw a trend line because everybody knows how to draw a trend line. So there's no point in me covering, trend lines. Everybody knows how to draw a trend line. You take the highs, you connect them, lows, connect them, and there are variations on trend lines. So there's no point in wasting time here. So I don't really see anything that's really sticking out here. But except for this here, it's important point to note is when the trend lines are converging. Let's say you draw a trend line at the bottom and then you draw a trend line at the top. When they're converging, coming together, like an apex or a triangle, that's because of a shortening of the thrust. So when that happens, you'll see that typically there's a turn. Again, this example right here, let me see if he has it. Here you go, the converging trend line. So you see 1, 2, and then below that 3, 4. If you draw from low to low and then draw from high to high, and you see them kind of tightening and converging, it's because the highs from 1, 2, and whatever the next number is, I guess 5 over here, that means the thrust is shortening. When the thrust is shortening, there's a problem, meaning it's losing momentum. If it's losing momentum, chances are there's going to be a break. So one of the things you want to do when drawing trend lines is look for that. Look to see if it's the thrust is shortening. All right. So this is done through doing both, like the trend line and the reverse trend line. So you're drawing two lines. First, you're drawing the trend line at the bottom in an uptrend, and then the trend line across the tops. You're not duplicating the line. You're creating a separate line, and that'll show you a shortening of the thrust. So it's just two lines, one for the connecting the lows and a separate one that's connecting the highs. Looking for them to converge, which will identify shortening of the thrust, which will identify potential reversal. Here's an important point. Notice the reversal occurred after the break below the reverse trend line with a declining wedge. So these two things are converging, almost like an apex, and then bang, takes it out. And yeah, when it overshoots the trend line, he's just showing that it's overbought right here. That's all. All right, so we're done with all of this. You know how to draw a trend line, right? So the whole point, if there's anything new besides what most folks already know, is that you can draw a line, a trend line, and then another trend line on top, in an up channel. And if those lines are converging, it means there's a shortening of the thrust, possible reversals coming, and drawing support, resistance line, trend lines, and channels, normal, reverse, or broadened, demands open-mindedness, etc., etc. All right. Okay, finally we get to story of the lines. What you should have learned so far is draw the lines. All right, so you draw the support and resistance lines, and you draw a channel. So the first step is to draw the horizontal lines, the support resistance, and then put it in a channel. That's how you're going to frame price action on whichever chart, on a daily, hourly, whatever, or a tick-based chart, doesn't matter. But that's what you're going to do. Now we're finally going into the story of the lines, and this is where it's going to get interesting, so I'll cover it. See how many pages this is. All right, I cannot stress enough the importance of drawing lines all over your charts. Again, draw the fucking lines. All right, they tell a story and make the price volume behavior stand out. And also they tell you where to take the trade. All right, they define the angle of advance, etc. Alert one to when the market has reached an overbought, oversold position. Also alert when the market has gone to a level of interest. They frame trading ranges, depict prices coiling to a point of apex. Why is apex important? That's how trading ranges are resolved. One way of resolving trading ranges is apex. The second way is springs and upthrusts. And help forecast where to expect support and resistance on corrections. All right? Meaning the rally, pullback. So the former support becomes resistance, former resistance becomes support. We will begin with a study of soybeans shown. All right, let's do that. Soybean. And this is it. All right. Support line A is drawn and B is drawn. Now, what do you notice when you draw A and B? What you notice is that's where the pullback after C stopped. Because you have line A and B, you know where to expect the pullback to end. Why? Because this resistance becomes support. That's all there is. All right, so he drew this, A and B. It broke out, right? Here's the breakout bar. This is a very important bar. I don't think it's talked about enough, because the breakout bar, it basically has a tendency to get tested. So when you, in addition to this line, you're looking for price to tag this bar, this breakout bar right here. So you have this, you have the break, you have the test of the breakout bar and the former high. And that's where you get ready, and I'll go into that, how to do it, go into a lower time frame to get ready to, put on the trade. Now, since you have C framed, guess where you get the next trade? On an upthrust of C. So there are two trading opportunities. One is on the test, on a pullback to B. This is your break and test trade. And the second is on a retest of C. This is your fake out trade or your upthrust trade. Okay. The other thing I want to show is we just learned how a trading range is resolved. Apexes and springs or upthrust. How was this trading range resolved? AB, how was it resolved? You see? What's this called? It's a spring of this low. How was the trading range A or B resolved? It was resolved with a spring that led to the high. So springs and upthrusts have a tendency to resolve trading ranges. All right. Where am I? When a line ultimately serves as both a support and resistance line, in an uptrend it might be support, in a downtrend it then becomes resistance. That line that becomes both support and resistance, he calls it an axis line. All right, so axis line is just a line that is always, always being tagged. And by the way, just so you know, like if you do a volume profile, it'll find axis line. It should find axis lines as well, but because the price is going to hover around that area and then near the POC. But that's a different story. I don't want to get into bringing any more than the basics. All right. So they frame two ranges. A to B is range 1, and B to C is range 2. Here's the point about that upthrust. The rise above the supply line, what is this? Market rose above C and did not have follow through. Follow through, you cannot have the concept of breakout without follow through. They go hand in hand. A breakout is not a breakout unless it has fall through. Simple as that. So, breakout by themselves will fail or random. And why are we doing all of this? We're looking for a turning point. All right. Why are we looking for a turning point? Because we want to put on a trade. We don't want to just draw lines. And here's an example where you're drawing two trend lines. One is from this low to this low, and then the second one is drawing across the highs. Notice the convergence here. That is a shortening of thrust, and eventually, you have a reversal. So here, when they were doing the line from 4 to 67 showed a lack of upward progress, which just means the thrusts are shortening, which means momentum is dying, which means possible reversal coming on the way. Okay, this is getting boring. So I mean, this is just the same thing over and over again. You have this line, this line, this line got resolved. So broke out, pull back, up thrust, shorting opportunity, spring, shortening up, long opportunity, resolved with the spring, went up, retested the spring, broke out. What happens to the breakout? It gets retested, buying opportunity, comes back down, has a spring, another buying opportunity, done, right? Here you draw the line and this line, and the top of the line, you notice it's overbought. Why? It exceeds the line. If it was not even touching the line and just start just couldn't really make it up, then it would be shortening of the thrust, meaning that from high to high to high on subsequent waves, none of them were able to come close to the line, and that's indication of weakening momentum. This is also really important. How the trend line as well as how support and resistance is violated is really important, because a lot of times you get the springs and upthrusts which show a very weak penetration of support and resistance, and that helps you consider, yeah, this is a spring, or yeah, this is an upthrust. So you want to see how it breaks as well as follow through. And here it is, and the amount of follow through. There's no ease of downward movement, then it could be a spring or an upthrust. By the way, springs and upthrust happen all the time. Like every chart, if you're ready to see them, they're there all the time. Just put a zigzag on it, you will see false move, false move, false move. Especially when the market is pulling back, tons of springs and upthrusts. So that's really important to note. And a lot of times on a pullback, you have a strong wave. That strong wave is a spring. It's not a change of behavior. A lot of times you'll see a wave that's strong. It is some type of profit taking or pullback or shakeout. It's not a change of behavior. And what you'll see, it penetrates the support level, and then it gets bought right back up and it goes right to the highs, and the trend continues. So this is why it's so important to understand the behavior around SR levels as really the first step. The rest of this is just analysis. So 3-9. Here's an example of an apex. You got two converging lines, it breaks out. So you could have a range, and this is what happens and breaks out. And when it breaks out, it enters a new range. The breakout from this apex occurred in the most lackluster manner, a narrow range, etc., etc. I don't want to get into all of this because the idea is that the apex just price reaches an apex and that's how a range is resolved, meaning it goes to the next range. It breaks out and goes to the next range, whether higher or lower. So one of the things you want to see when the market pulls back, there are two things you want to look for. All right, when the market rallies and it pulls back, it doesn't just rally, pull back, and then go higher. You know that typical high, low, higher, high, higher, low, higher, high, and then higher, low. It's not that simple. The market makes a high, pulls back, and then does some shit in the middle, like some consolidation. That consolidation should be analyzed. It may spring. If it has a spring, there's a chance it's going to break out to the next higher high. So you want to look as the market pulls back, look for the apex, look for springs as it's pulling back. A lot of folks will look for the ABC corrective pattern. That's really important, right? And the other one is just, the pennant, the wedge or pennant, the triangle, basically. This right here is a little bit of an overkill. I wouldn't, go trend line crazy like that with the apex. But the support line is valid because this is the low. You get your trade. That's your high. So support and resistance is valid. But the apex is a bit much. Okay, so where are we at this point? And just in a practical way, step one, draw the SR lines. Step two, draw the channel. Draw the trend lines or channel. Step three, look for a breakout. with follow through and a retest of the support resistance line for a trade. All right. In addition to this, when you are in a trading range, when price look for a spring, and when I say it's in a trading range, or it's in what is this, pullback or correction, look for the test of the breakout, spring of the first test of the test, or upthrust, right? And this is the typical ABC pattern, corrective. And when price is trending, one second, an apex. Why? That's why, to resolve the trading range. When price is in a trading range, look for springs and upthrusts along with apexes. When price is trending, look for converging trend lines, because it will indicate a shortening of the thrust, which happens a lot before a reversal to overbought, oversold condition when price accelerates through the trend line, accelerates a lot. Trend line indicating climactic ending or stalling behavior. Okay, so I think I got everything. Let's see. All right, so step one, draw the lines and the channel or trend lines, maybe the converging trend lines, and then look for breakout with follow through and then a retest of that break, and break out bar for a trade. Look for a fake out of the support resistance levels for a trade. So this step 3, this is what we want. The rest gets into analysis. All right, so in the trading range, what are you looking for? Pullbacks. You're looking for, obviously, test the breakout so you get a trade on. And you're also looking for springs and up thrusts along with apexes. Why? They resolve the trading range in order for it to go higher or lower. When price is trending, do this. All right, so that's what we've gone so far. Now, the next chapter is the logic of reading a bar chart. I'm not going to go into how to read a bar chart. I mean, it's not rocket science, right? So the key things to know is shortening of the thrust, clustered closes, ease of movement. All right. Did I go into, yeah, which is like the range of the bar. You want to pay attention to the range of the bar from high to low. You want to pay attention to the position of the close of one bar versus the prior bar, or a group of bars to see if they're making progress in the closes. And you want to take a look at high to high to see if there is good amount of thrust. And the wicks also matter a lot. So, you know, based on the body and the wick, a lot of times it really does matter a lot. All right, so I'm not going to go into all of this on how to read a bar. Because we want to keep it focused on trading and not on, you know, a lot of analysis. So what do we trade? We're going to trade springs, we're going to trade up thrusts, we're going to trade test of breakouts and breakdowns. So that's what you want to focus on. Everything else is supplementary. All right. So next time I'll cover springs. Thanks. Bye.